Welcome to The Explainer. So, have you ever hit that absolutely maddening point where you're ready to buy your next rental property? You have the capital, you found an amazing deal, but then suddenly your personal income completely caps your ability to grow. It's a super common roadblock, but today we're breaking down the exact blueprint to bypass it. We are talking all about DSCR loans. Look, if you're buying investment properties, you've probably slammed face first into the dreaded W-2 wall. The traditional process heavily relies on your debt-to-income ratio, or DTI. The lender is looking closely at your personal paycheck, your existing debts, and your tax returns. But what if you're self-employed? Or what if your tax returns are brilliantly optimized for deductions rather than looking perfectly plump for a loan application? Feeling restricted by your own personal income is exactly the problem that the DSCR loan was built to solve. Okay, let's dive into this. Here is our roadmap for today. 1. The W-2 investor wall. 2. DSCR versus conventional loans. 3. 5-minute DSCR math. 4. The real loan requirements. 5. Avoiding rookie investor mistakes. And finally, 6. Funding your next property. Section 1. The W-2 investor wall. For investors feeling totally boxed in by a traditional 9-to-5 salary, the conventional underwriting process just feels like a straitjacket. And this brings us to a massive paradigm shift. DSCR stands for Debt Service Coverage Ratio. Now, a DSCR loan completely flips the underwriting question on its head. Instead of asking, can this borrower afford this loan, the lender is asking, can this property afford this loan? It relies entirely on the property's cash flow. No W-2s, no employment verification, no personal DTI calculation. If the property generates enough rent to cover its own mortgage, you are in business. Section 2. DSCR versus conventional loans. Understanding this difference is a real game changer for your strategy, so you can pick the path that actually makes sense for you. Conventional loans demand a huge paperwork trail. We're talking 2 years of tax returns, pay stubs, and strict limits where lenders literally cap how many properties you can hold. DSCR loans, on the other hand, skip the personal paperwork. They want an appraisal with a rent schedule and proof that the property cash flows. The huge benefit here? Speed, scalability, and absolutely no portfolio limits. But keep in mind, the trade-off is that DSCR loans usually carry slightly higher interest rates and require larger down payments, typically around 20 to 25%. Basically, you're paying a premium for the incredible flexibility of keeping your personal income out of the spotlight. Section 3. 5-minute DSCR math. Now, what's really interesting about this is that you absolutely do not need a finance degree to figure it out. Before you even apply for a loan, you can run the math yourself in just 5 minutes to see if a deal is actually worth your time. Here is the exact 5-step formula. First, calculate the gross rent, which is everything that property brings in. Second, account for vacancy, usually subtracting about 5 to 8%. Third, subtract your operating expenses. This leaves you with your net operating income, or NOI. Now, listen closely here. This is absolutely crucial. Operating expenses include property taxes, insurance, and maintenance, but they specifically exclude the mortgage payment. Fourth, calculate the annual debt service, which is just your yearly loan cost. And finally, step 5, divide your NOI by your debt service. Let's ground this abstract math with a real-world example, just to see how it works. Imagine a duplex, where each unit rents for $1,400 a month. That's $33,600 a year in gross income. After we subtract our 7% vacancy allowance and standard operating expenses like management and maintenance, we're left with a net operating income of $21,448. Now let's say our estimated annual debt service on the loan is $17,500. We simply take that NOI of $21,448 and divide it by the debt service of $17,500. And when you do that division, you really want to keep your eyes peeled for this number right here, 1.25. This is basically the gold standard ratio. While our duplex example came in at about 1.23, which is still very strong by the way, 1.25 is what most DSCR lenders absolutely love to see. Hitting this mark means the property easily covers its own debt while leaving a comfortable cushion, and honestly, it usually unlocks the lender's most favorable pricing. Let's break down exactly how lenders read these results. Anything 1.25 and above is considered strong. If you land between 1.10 and 1.24, it's totally acceptable to most lenders, though you might see a slight rate adjustment. Now the 1.00 to 1.09 range, that's tight. The property is barely breaking even. And anything below 1.0 means negative leverage. The rental income literally does not fully cover the mortgage, meaning you'd be paying out of pocket every single month to cover the shortfall. Section 4. The real loan requirements. We really need to dispel a very dangerous myth right now. No personal income verification absolutely does not mean no underwriting rules. Here is exactly what lenders are evaluating instead of your paycheck. First up, you'll need a larger down payment, usually 20 to 25%. Second, your credit score still matters. Minimums generally sit between 620 and 680, and obviously you get better terms for higher scores. Third, they want to see 3 to 6 months of mortgage payments as liquid cash reserves just sitting in the bank. Fourth, you need an appraisal that includes an official rent schedule to actually prove the market rent. And finally, the property must be eligible. Typically, that means 1 to 4 unit multifamily properties, single-family rentals, or approved short-term rentals. Owner-occupied homes are strictly forbidden here, so keep that in mind. And this brilliantly illustrates the core philosophy of DSCR financing, Lenders are still heavily managing their risk. They're just shifting the microscope from your personal life to the property itself. As long as the property and your liquid reserves are secure, they are more than happy to lend. Section 5. Avoiding rookie investor mistakes. Okay, let's head into the minefield and protect you from the top errors that routinely blow up deals for first-time DSCR borrowers. Mistake number 1 is using overly optimistic rent numbers. When you're super excited about a deal, it is incredibly tempting to plug in a best-case scenario rent. Just don't do it. Lenders aren't just going to take your word for it. They will mandate an independent appraisal-based rent schedule. If your optimistic number doesn't hold up in the appraisal, your DSCR plummets, and your loan approval literally falls apart right at the closing table. Always use conservative, comparable-based estimates. Mistake number 2, completely ignoring the realities of property management. It is honestly shocking how many investors calculate DSCR using 100% gross rent, totally forgetting about vacancy and capital expenditures, or CapEx. You absolutely must include a 5 to 8% vacancy allowance and a 3 to 5% CapEx reserve for massive future repairs, like, say, a new roof or HVAC system. If those aren't in your operating expenses, your math is just a fantasy. Mistake number 3 is failing to shop around. DSCR loans are not standardized like conventional conforming loans. Different lenders have wildly different rates, minimum ratio requirements, and prepayment penalty structures. A slightly lower rate is basically meaningless if it comes with a brutal 3-year prepayment penalty that traps you. You really need to compare quotes across multiple lenders. Mistake number 4 catches so many folks off guard: underestimating cash-to-close reserves. First-timers often exhaust their entire savings on the 20 to 25% down payment and the closing costs, completely forgetting that lenders will demand 3 to 6 months of mortgage payments sitting untouched in the bank post-closing. You have to add all of these up into one total cash-to-close number before you ever make an offer. And finally, mistake number 5, treating every single deal as a DSCR deal by default. Listen, DSCR is an amazing tool. But if you have strong, highly documented W-2 income and you're only buying your very first or second investment property, a conventional loan might actually give you a lower interest rate and require a much smaller down payment. Run the numbers on both before you commit. Section 6. Funding your next property. Now that you possess the blueprint and know how to avoid the traps, it's time to talk about taking action. Your next step doesn't require a massive commitment. It really just requires 5 minutes. Find a specific target property, run the gross rent minus operating expenses to find the NOI, divide it by the expected debt service, and see exactly where your DSCR lands. So the crucial point is, doing this simple math check prepares you perfectly for the most important step, getting expert guidance. Because these loans aren't standardized, having a dedicated expert in your corner is absolutely critical. To get real numbers and navigate the lender landscape securely, I highly recommend reaching out directly to an expert. Contact K. Wittmann, NMLS number 2737675, DSCR Loan Specialist, for more questions at 310-903-7916 or email k.wittmann@loanfactory.com. Having a specialist map out the exact down payment and reserve requirements for your specific deal is exactly how you cross the finish line confidently. We've seen how DSCR loans totally strip away the constraints of your personal income and let the real estate stand on its own 2 feet. By valuing the property's cash flow over your paycheck, this incredible tool allows you to scale at the speed of your ambition, not the speed of your W-2. So what does this all mean for you? Well, your property is ready to work for you. Are you ready to let it? Thanks for joining me on this explainer. Now go out there and run those numbers.